Hi, everyone. I'm Rick Bensignor. Today is Tuesday, August 10th, and welcome to this week's In the Know Trader Show. Got a busy show today. We're going to start our trader education portion, and we'll talk about the art of the stock salesman. Our market overview, we'll take a look at the Dow, the US 10-year Treasury, and the US dollar. And that dollar chart will help us lead to our sector analysis this week, and we'll take a look at the metals markets through some popularly traded ETFs, and also the crypto market. So we'll look at Bitcoin and Ethernet, especially given the moves that they have seen in the last 2 weeks or so. I don't even think it was 3 weeks ago that Bitcoin was down at 30,000, and now it is 50% higher. So we'll take a look at those. Before we get into things, let me remind you about the products that we have at In the Know Trader. Thursday nights, we put out our weekly tactical trader report that will give you an in-depth view of the macro markets, meaning we'll look at US 10 years and key levels, often the dollar, gold, and most specifically, the really important things to look at within the S&P itself, a new ETF trading idea each week, plus a review and update and charts of every open position we have from prior weeks until it gets closed out. And then we have our monthly report called the 7-Eleven, which looks to outperform the S&P by being in no less than 5 or no more than 7 of the 11 SPDR macro ETFs. When I say macro ETFs, I mean XLK, XLP, XLY, XLB, XLE, etc. The 11 economic sectors of the S&P. Each one has a very actively traded SPDR ETF behind it. And if you're long the SPDRs, you get the entire S&P. What we do is try to beat the S&P by avoiding the underperforming sectors. We just finished our first year of doing this. As of July 31st, we outperformed the S&P by 2.61%, simply by being able to move our portfolio around and avoid the underperformers. Again, that comes out monthly, and at less than $90 a month, you can get involved in that if you want to do better than the market without taking more risk than being in the market. My email address, rick@inthenowtrader.com. Thank you for the emails I get frequently after doing this show each week, as well as, of course, all the response and things that I talk to In the Know Trader clients about. All right, let's talk for a few minutes about what I've entitled The Art of the Stock Salesman. And it's something I've talked about before, but it is so prevalent and unfortunately often, in fact, mostly so misleading that I want to make sure if you're listening to this show, you understand what people are doing out there to try to get your business. I was looking yesterday on Facebook, just scrolling through, my feed, and I counted 23 different companies telling you that they are the best stock pickers out there. And I'm not going to name out names, but there's one company that tells you that 99.7% of all people on Wall Street are not following our algorithm, which outperforms. Or is they called it one of the world's best algorithms. No, it's not one of the world's best algorithms. If it was, you wouldn't be selling it for $50 a month. There's people who tell you, one guy's on there constantly talking about how to trade futures follow his ideas for $5 a month, normally $197, but on sale for $5. The person has virtually no background, no track record, virtually no Wall Street experience, etc. There are people who are constantly, there's a commercial on CNBC 10 times a day about a company that says in the past their returns have outperformed the S&P by 500%. And the thing is, they over, I don't know, 10 years or whatever it is, we've outperformed the S&P by 500%. Anybody can make their statistics look what they want. And what's of course not included there is which names did you play? What was their beta relative to the market? Are you talking about that you told people to get into, Apple when it was $10 a share, which is great. You made a killing on it if you still have it, but that is going to massively skew your average results on everything else. So there are great salespeople out there who will convince you that what their product has or does is different than everybody else's, and that it's your means to riches. And all I can tell you is it's BS. It's not going to be. There is, I often write on Facebook to in response, when somebody says they're going to show you the secret of how to do such and such, and there is no secret on Wall Street. There aren't. There are skilled people who over time have honed their ability to trade well or to pick good stocks. There aren't secrets to doing it. And the bulk of the people who advertise that they have let's say extraordinary returns don't really have them, or it's concentrated on less than a handful of stocks that exploded over time. But if you're only going to allocate a certain amount of money to each idea, you made a killing on one that's going to throw the average off on everything else, and don't make it look like that they're superior stock pickers, and it all comes from one or two names. So the point here is, don't get suckered into all these advertisements from people who offer you the keys to success, the keys to retirement, how to retire at age 50 by listening to stock picks. All this stuff is just plain nonsense. I've been doing this for 40 years. I've held some of the highest positions, and not little rinky-dink Wall Street firms, but also, some of the biggest names on Wall Street, tier one firms. It is still ultimately, this game is never easy. It is about picking out performers, because if you just want to get the market's return, simply buy spiders or Qs or anything that's going to replicate the benchmark of what you want. If you're going to outperform and outperform over time, that is a whole different thing. So for instance, in my institutional newsletter, we track every single trade we put on. We've tracked it from inception. We'll make it public to anybody who asks. I don't try personally, I don't make false claims. My results are out there and very public. And I'm also the first to say, hey, we screwed up here. This one didn't work. We took our loss, we're out, and that's that. Move on. And I'm not trying to pitch myself here as anything extraordinary. I'm just telling you that in my particular case, I do this professionally. I've traded professionally. I traded in the pits, the commodity pits, for 12 years. At the very beginning of my Wall Street career, I grew up trading. I understand the game. And those who tell you, well, here's an example of something I've come across multiple times recently. There's one guy who you'll come across with some frequency, who'll tell you that it's irresponsible, and he loves using that word, it's irresponsible to own gold. And because, gold, well, forget about what gold did this, the last week or two, just in general, it's irresponsible because it's flat versus, other things that have moved up substantially. Clearly, this person has, despite his claim, no real contact with the institutional crowd, because it is not irresponsible to own gold. It is a hedge of a small piece of a portfolio that, unless you're mandated not to do that, has actually worked well over the last 20 years. And in fact, it's worked very well. And it's this type of stuff where they'll go, it's just irresponsible to own these yellow chunks of metal that have no value. Well, the price of gold in the year 2000 was, I don't know, probably $300. I'm just guessing, and now it's $1,700. It's a hedge, and that's all it is. So it's these type of things where people talk so cocky and so like off the cuff and so know-it-all that I really advise you to stay away from and look for people who have real backgrounds, who really do this, not people who've grown up and all they've ever done is been a technician. And they'll say, well, I'm an expert chart reader. Well, you know what? There's tons of expert chart readers. The question is, can you actually figure out what to do and then successfully do it? That's the question. It's not if you can identify a pattern. It's, can you take advantage of it? How often are you wrong in your interpretation? How often do you sell lows? How often do you buy highs on breakouts that end up being false breakouts, etc.? There's, I can go on and on about this. My point is, be careful about whose recommendations you follow, the background they have, their success, their consistency, what type process they use. Does the process make sense? If they're shoot from the hip and they're all over the place, that's generally not the type of thing that's going to work over time, etc. So again, just general caution about people who are great salespeople, try to get your business, but not good at what you're actually purchasing. Okay, a few charts. Let's first go to, here it is. So here are the S&P sectors. Again, the 11 macro sectors versus the spiders themselves. So here, actually, let me start this off of the StockCharts page. This is live through yesterday's close. So on the year, spiders are up 19%. Outperforming that is communication services, energy, the best leader, outperforming by 31.5%. Financials at almost 30%, and real estate 29%. These are all these outperforms. These are flat out numbers on the year. Here's the outperformance. So you can see three real big winners: energy, financials, real estate. The biggest loser, staples, utilities, and discretionary. And most of the other ones are somewhat near. I guess we'll give a little edge here to communication services. I've said in the past that I believe that energy was going to remain the best outperformer for the year. Financials and real estate keep creeping up as interest rates now potentially have a double bottom and are starting to move up. So I may end up being wrong about that, but certainly you're still seeing significant outperformance from those three areas. Okie doke. Now let's get to, let's take this away. And we'll start looking at here the market overview before we get into the individual stocks. So let's start here. Weekly chart of the Dow. Here's the trend line off of the March 2020 low. We broke that a couple months back. We came to it one time, have gone sideways, and we're starting to move up again. The resistance areas I see right now are 35,470 on the S&P. That's only 240 points above where we are, and then backing up against this trend line too. Even though we've seen some 13 counts here, market has only been able to go sideways from them. There's obviously been no significant correction in the market. We're also on a current setup count here, which is occurring in the middle of this 13. So probably expect this to finish up a 9 count too over the next few weeks, and then we can evaluate again. Most important support here is into this highlighted zone. It's where we've got the cloud model's baseline, the propulsion momentum level to the downside, which my guess is if we got to probably gets rejected. And then 2 trend lines of significance. So, somewhere from 33,000 down to, let's call it 32,000, give or take, is the important support right now. US 10-year. In the know traders know that we called this perfectly. This is the zone that I expected not only the yields to bottom into, but we said between 115 and 105, 1.15, in other words, 1.15% and 1.05% would be the likely bottom in yields. We're looking here at the TNX. So the TNX got down to 11.28 was the low of the move. It got tested 2 weeks later. Obviously, we moved back up. We're back into the channel that we had been holding. Look for resistance as we back up against the trend line that we broke, as well as the 14.70 level, which of course is 1.47. So somewhere in the 1.4s, look for resistance before it potentially pulls back a bit. But I told clients that I sold almost my entire portfolio of bonds when we got down here in yield terms, which obviously means we got up at the best levels of price on the pullback that we saw since the whole breakout really started the first week of January. So I have a small piece left on the odd chance that this doesn't end up being the low when we pull back a little lower, but for the most part, I am out of the bond market and will likely stay out of the bond market at this point until the bonds get a much higher yield that makes it worthwhile in me buying bonds for the yield. Right now, I just see too much chance of not only yields going higher, but also will not be offset by the losses you'll take on the actual price of the bonds. So I do believe that the lows that we saw, that's slowly, the lows that we saw back here in the summer of 2020, spring and summer are the lows. The U.S. is not going into negative yield territory the way Europe and the lows or got real close to what we're going to see as lows, and that's my view on bonds. So I do think yields are heading higher over time, and I have actually no personal interest in buying a bond for 10 years that gives me 1% on my money. I can do much better than that on my own. Stuff that we said. So here we go. Here's the weekly DXY chart. So let's go back to 2018. Aggressive sequential exhaustion signal followed by standard sequential. 2 months later, pretty much same price, get the massive move. And we start seeing 13 show up on the top side. We get our first exhaustion signal here, sells off for several months. We rally again, get an exhaustion signal, sells off and goes sideways. Finally goes higher, makes a new high, sells off from that 13, gets another 13, sells off from that, gets a 13, gets a sharp sell-off. And we get the one spike higher in March of 2020, just after stocks had sold off sharply in February and March. So there was a spike into the safety of the dollar. That was it, fell apart. 13 here, downside exhaustion right at the end of 2020, first week of 2021. We nailed that move. And this told us not also that you wanted to be long the dollar. And we already hit our target at, where is it, 93, I think just about 92.89. There's a target at 93.11 also, which showed up from the daily chart. The way this is looking now, and you'll see this similarly when we look at the Bitcoin chart, there's an area, I drew this trend line here because even if I took it back, most of the price actions above it, when we finally broke down, the highest we got was 94 and change, and then 94, and then 93 and change. So there's really a zone here. Let me draw another approximate line of, so in between these two kind of maroon colored lines, the bond market, or I'm sorry, the dollar index hardly traded. And my guess is that we'll probably go and play into this zone a bit because we need to squeeze all the shorts out here, and yet trap longs up here may not get a chance to really get anything beyond the 96.5-ish level. to get out. So my guess is the dollar index makes a new trading range. We're not there yet, but that we will shoot up there and kind of play into this 94 to 96.5 range for a while, which now leads us to some of the things that are related to the dollar. So let's start with precious metals. We'll go to the GLD weekly chart. And there's a few things of note here that are quite concerning. One is that this green trend line broke this week. I'll pull this up. You can see. All right, so here's real-time price right now of the GDX as we record 161.77, right? So we broke this trend line that had 4 touches to it. And the other thing that's concerning, before I talk about what might still be bullish here, is that the cloud's lagging line, this blue line, has now broken beneath its cloud. And that's the first time on the rally. So since the 2018 sideways pattern, since we've gotten into this whole bullish leg, this is the first time that price is underneath the, that the lagging line is underneath its cloud, as well as price being underneath the bottom of its cloud, which you had seen previously had tried to hold its support. So it's fairly disconcerting to see what's going on in the gold market right now. Now, some of the selling in gold might be related to people selling out of gold and moving to a crypto as a form of hedge. In either event, the market made a 9 on the high, a reactive 9 low, a reactive 9 high. We're only on bar 2 here towards a potential 9, which would have to come in lower. So I am concerned about gold at this point. Now, that's the bigger picture. On a shorter term picture, let's take a look. Are there any chances it's a false breakdown? Well, yes. Why? One is this week's low hit the propulsion exhaustion target, and just beneath that at 157.30 would be the most recent TDST line. Either of those could hold a support. Secondly, where this low is this week pretty much lines up with the TDST line here from farther back in time. So here, 160 and small change, we're holding on to that for the time being. So, if this week closes underneath the trend line and next week we're right back above, maybe it's really nothing. But excuse me, looking at this picture, it's really hard to be particularly bullish gold right now, other than it's against some prior support. But from a model point of view, I'm concerned. Let's see, do I have it up here? No. Okay, so now let's look at SLV. So here's an interesting picture of silver, right? So this is the popular ETF. Pretty much tops on this 9, goes sideways, gets a 13, goes sideways, gets another 13. Bounced off the cloud, which was good at the time, but now we've done another 13. But this 13, when that was made, we were already in the process of starting a 9, and we're already on the 9th week down. So it's potential or possible that silver is also closer to a bottom. And if you look and go back here, you see where these lows are. They're still beneath where we are now, but it's possible that silver ends up hanging in here, and that this is just a move that's really shaking people out of metals, only to see it potentially hold. Now, if this level breaks, look for the bottom of the cloud to be potential support at 1942 in SLD. If that breaks, well, let's call it 1912 to 1942 as support. 1912 breaks in any meaningful way, then this thing is in much more trouble, and next target down is right around 16.5. So this too, you could take the chance to buy into support, but it's very iffy. I'm actually going to skip copper and platinum right now. They're not actively traded ETFs, and I want to get to just make sure a couple of things that we get to in time. Let's look at the GDX. So that's gold stocks, right? Gold miners. And you can see that the last time down held right to the cloud bottom. We do a 9 up, we push a little through the cloud, come right back down. You'll see we've got 3 support levels. One we're a little bit beneath, which is 32.56. Next support level, 31.64. Bottom of the cloud, 30.98. If that breaks, then we have more concerns. So we're only on a 2 count here too. So nothing that definitively says come in and buy right now. If anything, buy some weakness. Let's get to Bitcoin. If we have time at the end, we'll go back to those few that we skipped. So I'm going to look at Bitcoin futures because I can do my best analysis on them. They trade pretty darn close to the price of Bitcoin. This is going to be the August contract. So it is, there's just a small difference in price between actual Bitcoin and Bitcoin futures for the August contract. Most importantly, 13's on the top. If I remember correctly, the daily chart had this as a 13. This is a weekly chart we're looking at. And within a week after the all-time high was made, I said that all-time high is going to last a lot longer than most people want to see it last. And obviously it's been months. Now, 13's on the bottom. Notice in June and July, twice we got down to what were the January lows and held. So head and shoulders that never broke to the downside, held right to its neckline, downside exhaustion signals, boom, off to the races, to the upside. The big gap on, I think it was over the weekend, so Monday, and then it just continues. We got very close to a 50% correction of the move down from the highs. So here I've highlighted in yellow the Fibonacci retracement box between the 38 and 62%. And then in pink, I've got this minimally traded zone, same type thing of where we broke down from. And when we sold off, where we came back up to. And in this zone, we've hardly traded. So similar, I think the dollar is going to do this too. It's just that Bitcoin's ahead of the game. It's going to establish a trading range, probably not much higher than the top of the box, 51,300. And at this point, I suspect from where it broke out from, and the bottom of the minimally traded zone is going to be the bottom, which is the very low 40,000. So between 40,000 and what do we say, 51 and change? Yeah, 51,000 and change is where I expect Bitcoin to trade now and set up a trading range. And then lastly, as we're starting to run out of time here, Ether. So on the recent sell-off in June and July, the lows here didn't even test the lows from February and March. Remember, Bitcoin tested the January lows. Ethernet futures only started trading in February, so they didn't go back as far in time, but we didn't even get that low. So I took the all-time high down to the low. You can see in between these horizontal purple lines is what the Fibonacci box would be. And it's also a place that kind of didn't trade a heck of a lot. So I'd expect things to kind of hang out in here into this range for a while. We're already on a 7 count to the upside, another couple of days, and that could be all before we get a pullback. Would I buy a pullback? Yeah, I would buy a pullback probably to something near the upper 2000s to, well, yeah, I just call it like the 2750 up through maybe 2900, something like that. That's it for this week. I hope you enjoyed the show. I'm Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.